So there has been a lot of uncertainty in 2025, right? And investors are grappling with this question that whether it's the right time to put the money into the market, or will this be a market will continue for a bit longer, right? So, but if you look at just the history of the Indian markets, last 45 years of history that we have. So in past we have seen many challenges, right? So starting with right from the Harshad Mehta scam to the terrorist attack, and then global financial crisis, and then the NPA crisis for the Indian banks, and very recently COVID and the Russia-Ukraine war. So all of this triggers, all of these events were trigger for the market to correct by 15 to 20 to 30% also, right? At some point of time. But the market has bounced back from all those fears. In fact, in the last 4 decades, the market has fallen by more than 30 times, fallen by 30 times more than 10%. So the corrections are part and parcel of investing in a volatile asset class like equity. And as an investor, right, it should be our endeavor to put money wherever we find that the valuations are cheap and the earning growth have a tailwind there in the market. For example, currently, if you look at on a 1 year basis, the index is down around 5 to 6% from the peak. And we have in the last 1 year has compounded around 5 to 6% of EPS on the lower side. Before that, we were compounding, the earnings were compounding at the rate of 15 to 20%. Last 1 year was slightly slowdown in the earnings growth. So even with lower earnings growth, there is a growth of around 5%, right? So it means that the index valuation is down around 10% from what it was a year back. So as an investor, it's an ideal chart, time for us to invest more. And if there is a correction in the market which is going on for this current year, maybe next year the market can recoup those losses and go on to make new highs again, right? So volatility is part and parcel of the game. And if the factors which led to the volatility seems to be coming to an end, then it's our view that the another rally is just around the corner. So what we'll do, I'll just discuss some of the current issues which are impacting the market. I'll also discuss about the valuations of the market, right? And then my colleague Vijay will discuss about some of the themes that we are bullish about, and he will also discuss one of the case studies. So starting with the one of the most pertinent issues, right, which has led to the fall in the market. So as we remember the quarter four, we had seen a very sharp fall in the market, right? And there was a uptick in the market again in the first quarter of this year. But again, as we entered into the second quarter, July and August, we had seen the indices to correct on a weekly basis. So every week for the first 2 months, July and August, the market has corrected, right? And that was for a very simple reason that the final day of the rollout for tariff was near, right? So on August 7, we had this 25% tariff, and then August 27 was the deadline for the penalty tariff additional 25%, which has led to the maximum number of which has led to the maximum breakdown of sentiment for the Indian markets. And we have seen the markets to correct by again 5 to 8% across indices, right? So because what has happened because of this additional tariff, that some of the sectors where we are exporting our goods to the US, right? So we have close to $18 billion of bilateral trade, and we are doing a $40 billion of surplus export to the US. So the idea was that because of the tariff, that surplus export should come down. And actually, if we go by one of the reports from the Ministry of Commerce, right, what it has mentioned that because of the 50% tariff, there will be a loss of it, like roughly around 30 to $35 billion of exports to the US. But we have to understand that whatever the export that we are doing to the US, these are low value added items. For example, gems and jewelries. So we are not exporting finished jewelry to the US. We are exporting the uncut gems, which are used there as as a product. So the value add is very low on that segment. The only flip side of that is that these are the sectors, for example, textiles or some ancillary auto parts manufacturing. So these are the segments which employ large number of people. So there will be jobs impacted for 2 to 4 lakh of people which are directly employed into the segment. But if we try to decipher the economic impact of those tariffs, so that's on the limited range. So if we go by the study, right, what we have conducted in the last quarter when, the last month when the tariff was kind to be actually was about to roll out. So the actual impact on the market will roughly around 0.6 to 0.8% of GDP. And then other segments like pharma, electronics, which are currently we're exporting to the US as under the goods export, are currently exempted. Also, the services are kind of exempted as of now. And the other sectors like export of steel and all, steel and steel products are currently exempted, right? So there is a very few sectors which are kind of impacted because of it. There could be some bit of loss of jobs because of that, because these sectors employ a large number of population, but the economic impact is kind of limited there. One of the flip side of tariff is that it has led to the weakening of currency, right? So there is no direct impact or material direct impact on the economy, but there is an indirect impact, which is the weakening of the currency. And because of that, we have also seen the FII to be persistent seller in the last 2 months. So that's impacting the market, in a negative way. And what our view is that, whatever the currency weakening that we had to go through to make our exports slightly competitive, so we have already gone through it. The currency has already weakened by around 5 6% from that. Index has already corrected by 6 7%. And if we go by the recent sort of interaction that are happening both between the India and the US counterparts on the tariff front, so that's coming out on a positive note. Probably if we can just move to the next slide. So if we try to understand what the commentary was like, very recently the US trade representatives were in India, right, around 2 3 days back to discuss on the tariff front. And the CA Nageswaran, what he has mentioned that the tariff issue will be resolved in another 8 to 10 weeks. And what's also happening in the US is that the Supreme Court there has mentioned that the tariffs are unconstitutional and they will be challenging the decision to roll out the tariffs. So the hearing is on 5th of November. Our expectation is that there will be a resolution before that. And if we go by what the trade representatives have also discussed, the understanding is that the 25% penalty tariff, right, that will be completely waived off. And the actual tariff of 25%, which was calculated because of the differential in the exports, that will be fairly lower in the range of 10 to 15%. And if that will actually play out in the month of, let's say, November, right, that will be a good trigger for the market to rally because the INR is already depreciated. The foreign portfolio managers have already taken out considerable amount of investment from the Indian market. So they are the short positions built on the Indian equities are on the very high side, close to 90%. So any sort of trigger and positive news on the tariff will be a trigger for the market to rally. Again, government has also done its bit to support the domestic market. So, for example, we have signed up BTA with UK. We are also in a process of signing up the BTA with European Union. Also, we have signed critical mineral deals with a lot of African countries and South American countries. And we have, again, discussion going on for increasing the export to the markets like China and Russia. Additionally, we have also opened up the FTI from the Chinese into the Indian market with complete technology transfer. So all those are key triggers for markets, that will not see the benefit in the short term, but for a long term, these are going to be having a very positive impact on the overall economy. The very important step that the government has taken was the GST rationalization. So please understand the tariffs are short term in nature. That will be levied for 3 months, 6 months at max, and then things have to course correct. But in response to those tariffs, whatever the steps that governments are taking, right? For example, signing the BTAs or allowing the FDI by China or increasing the export to Russia, or let's say the GST rationalization. So these will have a very long term impact on the Indian economy, and it will make the economy more resilient and more diversified. So Prabhu, if you can just move to the next slide. Yeah. So coming to the GST rationalization part, we believe that that's a very important discussion and long due sort of reform that has come from the government side. If you look at the extent, so currently, the 28% slab is mostly scrapped, and mostly now 12 and 28% slabs are mostly relaxed now, and most goods are now taxed under 5 to 18% slab. And what it does is that it leaves with a lot of surplus disposable income with the masses, right? So one of the report that has suggested that the tax reduction could have a multiplier impact on the economy to the tune of 2 lakh crore, right? And that impact we are already seeing during our channel checks. So, for example, when we talk to our OEM partners, OEM manufacturers like Maruti or Mahindra and Mahindra, So we believe that the orders that they have for this festive season is slightly on the higher side, right? So people are already rolling out and doing the bookings for their private personal vehicles and all. And again, what it always also do that over the next quarter three and quarter four, which are mostly the consumption heavy quarters. Quarter three is the festive quarter, and quarter four is the wedding quarter, right? So we'll see the consumption of disposable goods to go up in those quarters significantly. Again, from the month of April, we have the eighth pay commission rollout that's happening, right? So overall, we feel that because of the steps taken by government as well as the RBI in terms of slashing the income tax, right? There will be a lot of disposable income that will be coming into the economy, and it will be having a multiplier impact. So it will create a virtuous cycle where the consumption will go up, and it will lead the manufacturer to produce more. That will also lead to the increased sort of jobs into the economy, and then finally it will again come back to the more consumption, right? So that virtuous cycle will play out. We have to wait for maybe 3 to 6 months to see that playing out, but the multiplier will there in place to support the economy in the coming months. Prabhu, you can just move to the next slide, please. Again, one of the more important steps, that has been taken by the Fed is a 25 basis point rate cut, and that has come in after a lot of discussion, debate, and pestering by the U.S. president, right? So finally, we have seen a 25 basis point rate cut. If you go back and see how the markets have reacted to the rate cut cycle, so what it does is that when there is a rate cut into the economy, it basically lowers down the borrowing cost, which also lowers down the risk premium, right? And because of which we have seen the intrinsic value of the asset class to expand because of that, right? So historically, if you look at the market has always reacted positively to the rate cut news. And the expectation is that 1% rate cut leads to a 15% expansion in the multiple, right? So we'll see that to play out soon. We have already seen a 25 basis point rate cut, and there is a slated 50 basis point additional rate cuts over the next two meetings in the US. So, but again, things are quickly changing for the US market because of the tariff and then the other drastic steps that US government is taking. So we have to see how the job market, how the economy is responding to that. But as of now, the dot plot suggests that there will be two additional rate cuts of 25 basis point each for the US markets. And that will be a trigger again for the markets to rally. Now, Prabhu, if you can just move to the next slide. Again, what the RBI has done domestically was quite remarkable. So RBI has foreseen the slowdown in the consumption, and it has actually started to cut the rates even before Fed, right? So till now, January till date, we have already seen a 1% rate cut from 6.5% to 5.5%. And what we have just seen in the previous slide was that 1% rate cut is a trigger for the market to expand the valuation by around 15%. So that means additional 15% return, which is there for the markets, right? But if we look at the Indian markets, we have gone nowhere. It means that we are not fully baking in the impact of the rate cut, right? And again, the economy is not responding to that, right? So very recently, we have seen the quarterly GDP growth number to go up. But if you look at the historically also, right? So the first rate hike was taken somewhere around June 22 and then September 22. So if you look at the slowdown, the September 22 rate hike has finally led to a 5.7% sort of growth in September 24. So there is a delay sort of transmission of interest rate movements, and it's finally reflected in the economy with a lag of 2 to 6 quarters. So whatever the steps that the government has taken, let's say from beginning of January, we have in some fast moving indicators, we are already seeing the result of it. But the economy as a whole will reflect the true impact of it, maybe early next year or by the mid of next year. So that's the ideal point of time. But the important point to note here is that the government has shown the intent, and the RBI has shown the intent to revive the economy and to put its supports towards making the consumption to be the first and topmost priority of the government, which was not there in the earlier earlier cycle of BJP government, right? So earlier there was an infra push, now it has moved to the consumption push. So the changes will put its will show its impact in the coming quarters. That's the view is. Prabhu, if you can just move to the next slide, please. Yeah. And again, like, if we just track and go through what the majority of the indicators are suggesting, right? So the inflation is at the lowest point of the last, 6, 7 odd years. The GDP growth, which bottomed out in Q2 last year, has finally started to revive, and it has posted a 7.8% growth in the last quarter, right? The expectation was of around 6.5%, and it has surprised everybody with the upside that we have posted. And actually, with the tariff, where we were expecting a, 0.3 to 0.4% impact on the overall GDP number. So actually, that's kind of nullified because of the higher 7.8% number that we have posted. The GST collection are kind of showing robust, and we are seeing the GST collection to increase every quarter from Q2 to Q1, like this financial year. So we have seen that number to go up only, right? Q2, this ongoing quarter will be slightly on the lower side. That's because of the seasonality. But again, it will be higher than the Q2 of last year, right? And lastly, the manufacturing PMI is at the highest band of around last 17, 18 odd months. So it shows that the manufacturing activity, which kind of slowed down last year, had started to come back. Government has shown the intent to cut the rates to revive the economy, and the economy is responding to it. Also, we have a favorable sort of inflation, right? Numbers that's coming in. So that's put more firepower to the RBI to cut interest rates in the future now that the Fed has already taken out a rate cut this cycle. So overall, the economy seems to be in a pretty good shape. Q2, there were some of the sectors, for example, mining and all, kind of impacted because of the heavy rainfall. But overall, we are very upbeat that Q3, Q4 will see the strong numbers coming from those segments, and that will be a good, input. That will be a good trigger for the market to rally from there. So now coming to the next section, which is on the valuations and how we see the things to move forward. So currently, if you look at the most of the sectors, right, and most of the indices, so that's trading closer to their 5-year median PE. And on a forward basis also, right, if we compare the current valuations which are there in the market, and if we compare that to the valuations which were there at the peak a year back, so there is a cool down in the valuations, roughly 15 to 20% on the forward valuation number. But again, some of the investors argue that the valuations looks a bit punchy, and it's not the right time to invest some money. Wait for some more time to wait for some more time for the valuations to correct. So we just wanted to discuss why the valuations looks a bit reasonable to us, right? So Prabhu, if you can just move to the next slide, please. So whenever we compare our valuations with that of the index, right, on a historical perspective, right? So if you look at the last 20-year data, every year on a year or 2-year basis, the valuation has expanded by around 2.5%. It means that every year, even if there is zero earnings growth, the market has delivered 2.5% return, right? And that's because we have certain fundamentals which are kind of working towards our way and helping us to get that higher multiple versus the global peers. So for example, like what the valuation of 23 may be looking like, we are trading slightly higher than the historical average or trading closer to the historical average. But if we compare that number to the forward, 2-year forward number, so that will be the actual valuation number will be in the range of 23 or 24. So even without doing anything, let's say in 3 years, we are generating just 7.5% kind of return because of the multiple expansion. So that shows that the valuation will keep on expanding, and the looking at the numbers from a historical perspective will always make us feel that the markets are kind of expensive, and it will restrict us from taking an investment decision based on that. Now, I'll just try to discuss some of the factors which are helping us or helping the Indian market to have the valuation elevated. Prabhu, if you can just move to the next slide. So if you look at the volatility in the GDP growth rate, if we compare our numbers with that of the global peers, what we have seen is the volatility in the GDP growth is the lowest for the market, and valuation, which is nothing but the the factor that you assign to some asset class or some country's numbers, it's mainly because of reflection of the certainty of that number, right? So in future, if let's say uh, India is going to be more volatile, will not be commanding the same sort of valuation. We are commanding the higher valuation because the volatility is on the lower side for us. And it means that there is more predictability for the India's growth rate, more certainty for the India's growth rate. And that's why, like, the higher valuation is there. Again, we have a 3D combination that's working for us, which is democracy, demography, and the domestic economy. So if we look at from, like, between India and the Europe, all the neighboring countries mostly are, like, run by a particular party, or either military run, or let's say, like, they have their governments toppled and, like, run by some ad hoc governments at this point of time. So democracy commands a big premium. And again, if we compare our demography, so we have the highest number of working age population, right, which is coming to the working force. And we are roughly equivalent to 15 to 20% of the global working age population, which is contributed by us. So, and again, we have a huge amount of cheap labor as well available, right? So that's why, like, the demography is clearly in our favor. And third is the domestic economy. India is the only largest country in the world today which has demonstrated a growth rate of 6%. The China's growth rate is roughly in the range of 4.5 to 5%, US, Europe sub 3%, right? 3%, 4%. So we are the only largest country. We are the fourth largest country today, growing at a rate of 7.8%. So the domestic economy resilience also warrants the higher sort of valuation. So this 3D combination is propelling the valuation to near to all-time highs currently, right? And even with, like, all sort of tariffs and other external factors, the market is not correcting, like, either it has corrected in the past, the way it has corrected in the past. So probably we can just move to the next slide, please. The other key point to remember is that corporate profit to GDP ratio. So it's kind of expanding currently. We have seen that expansion happening in the previous infra cycle of 2003 to 2008, where it has expanded from 2.7% to 5.2%. And from then we have seen a decline from 5.2 to 2.1%, mainly as our banks were grappling with the NPAs and all. And we have DHFL crisis, and like, which impacted the sentiment as well as the concern around the corporate governance for the Indian markets. But post COVID, a remarkable thing has happened. We have seen the companies to deliver. We have seen the companies to improve the operational performance. For example, pre-COVID, small caps were trading at were doing a ROE of 12%. Post COVID, these same companies are doing a ROE of 16%. And the third thing is that, like, there is a lot of free cash flow focus that's happening on the companies. So as the companies are delivered now, whatever the profit that they are generating, actually these are the coming to the company's balance sheet in form of free cash flow. And as against, like, the cycle that we have seen, which peaked out at 5.2% previously, that cycle was infra led. And there is a limit to it, which, like, you can put the money into the economy and, like, try to build all sort of infra. So that has, like, a limitation in terms of absorption. But the current cycle is mainly driven by the high quality companies. And we can see that number to even inch up higher in the future, right? And because of this high corporate profit to GDP ratio, we see that valuation to remain stretched for the Indian markets. Prabhu, if you can just move to the next slide, please. Also, like, what's putting a support to the fall that we are seeing currently is the strong SIP numbers that's coming into the economy. So 3 year back, we are doing just around 10% of what, like, we are doing today. So for example, today we are doing a 28,000 crore. 3 years back, that number was roughly in the range of around 1,000 crore or 10,000 crore. That sort of odd numbers which was out there. So that number can again expand to a 1 lakh crore in the next 4 to 5 years on a monthly basis. And and because of this monthly flow that we are getting into the economy, this monthly flow that we are getting into the economy, that's putting a cap on, like, or floor to how much the market can fall. So what we have seen in the last 1 year is there was an incessant selling by 3 lakh crore by the foreigners, right? FIIs. But the domestic investors have put in around 5 lakh crore, the highest till date, into the market, and bought all those, like, falls. So for example, like 50% tariff that impacted, like, put by US on Indian exports. So that was not the part of many worst case scenarios that many of the investors have done. But even with that 50% tariff, we have just fallen around 5 to 8%. And the day it was imposed, it has come into picture around August end. So that was kind of bottom for the market, and the market started to move up from there. So that's the kind of nature for the market is currently, right? So we have such depth in the market that all the bad news are kind of digested, and we have some floor there, which is uh, a leading to a controlled set of selling in the markets. We have seen very high selling by FIIs. We have seen very high selling by promoters as well in terms of QIP and other issuance in terms of high IPOs that are coming, high number of IPOs that are coming. But again, we have enough domestic liquidity to absorb it all, so that market moves in a very calibrated manner and doesn't go either on the upside, it doesn't surprise very high, and neither on the low side, it gives a 30-35% kind of drawdown. So that's the strong nature of the persistent SIP flow that we are seeing. And one of the key factors again is that, Prabhu, if you can just move to the next slide, please. That if you look at the global equity market performance, so all the markets, right, be it European markets, be it Chinese market, be it South Asian markets, American market, South American market. So every market has delivered good returns in this year, bearing the Indian markets. So the things have actually reversed for the Indian market. Till last year, we were the best performing market, and then we have gone into a year of consolidation. So whatever the premium at which our market was trading, so that has completely reversed now. And that's again a key trigger for all the global participants to come back to the Indian market now. Now that we are at 15% net FI or 15.5% net FIA exposure. So at current level, we see very limited sort of scope for foreign investors to continue selling into the market. There could be minor number that can come on a day-to-day basis, but on a trend wise, we see that trend to stop now. And from here on, if the earnings will come back, right? So remember that the FII outflow started when the earnings started to become weaker. And now that we have seen on a quarter on quarter improvement in the earnings growth, and as and on when we move on the subsequent quarters, the earnings will come out stronger. We'll see the foreign participants to come back to the Indian market as the valuation premium has come completely shrinked now that it was there last year. So just to demonstrate in the next slide, Prabhu. So this is a chart of how the valuation was there for the Indian markets versus the emerging market peers. And the black uh, chart basically shows the premium of the Indian market versus the emerging markets. And the green chart basically shows the 1 year forward return. So we have underperformed the emerging markets, let's say in 17-18, and then post-COVID 2021 as well. And in both the periods, the 1 year return was kind of on the higher side as well, right? And we are going through the same phenomena. So the typical outperformance of Nifty versus emerging market is around 11%. We are down currently 20% today. So that's a huge outperformance versus the emerging market. If any fresh money that has to come from the foreign investor side, there is no reason for them to continue pumping money to markets which have already rallied and looks slightly stressed on the historical perspective. So we expect that as the earnings will come to the Indian markets, there will be again flows coming back to the Indian markets again from the foreign perspective. Now, Prabhu, if you can just move to the next slide. Just quickly to discuss on the small cap cycle, as we have the funds which are which have which have higher exposure toward the small caps. So if we try to analyze the last 25 odd years data, 22 odd years data, so there have been multiple cycle, right, from 2005 to 2008 to 2004, 11, 14, 17, 20, 21, 24 as well. So we have seen in all those years the market to decline roughly in the range of 25% to 35-40%. And in some instances more than 50% as well. But there has been a very notable change that we have seen in the last two falls, right? Both in 22 and 25. That earlier the fall was kind of elongated for elongated period, and it was of the higher magnitude. So, for example, we have seen 79% decline in 2009 and 54% decline in August 13 and 56% decline in 2020. We don't see that cycle has changed, and something has fundamentally changed for the Indian small caps. As I have mentioned, that the promoters have become more more astute about how they want to run the business. So that's reflected in the high ROE, high FCF generation, and high low sort of debt to equity leverage that they are taking. So, and again, like, because of the increased penetration of, the Indian equity participants, so we see that, like, the fall is kind of limited now. In 22 to 22 also, we have seen a 25% decline. In 25 as well, we have seen a 26% decline. So overall, we see that the market has hit a bottom and we are at the cusp of new bull cycle. There could be, like, challenges mainly coming from the external side in a very short term, but those challenges will be an opportunity to add more inflow to the fund, more money to the small caps or the mid caps names in the market. The small caps will continue to deliver, but the idea is that put your money where the high earnings growth trigger is. So in next slide, I'll just discuss the valuation numbers. So this is how the just to quickly recap, this is how the market has performed. On the drawdown side, the market has delivered a 37% drawdown. And on the upside, the market has actually tripled, right? 200% odd return. In the last cycle, also, there was a drawdown of 25%, and then the market has gone by 2.5x. We have seen a similar drawdown, and the other bull cycle is in the making. So it will be ideal time to put the money. Prabhu, if you can just move to the next slide. Historically, we have seen the 5-year EPS CAGR of the large caps, mid caps, and small caps to be very strong in the range of 20% to 26%. But if you look at the forward earnings growth, the maximum sort of impetus is coming from the mid and small cap side, where we have 15% EPS growth for the mid caps, 20% for the small caps, and even higher for the portfolios that we are managing. So my colleague Vijay will discuss the rationales, like, some of the key themes we are really bullish on and where we are seeing this 20% sort of compounding happening. So over to you, Vijay, now. Thank you.
Yeah, thank you, Prabhat. Now we will move on to the next section. So basically in this section, we will cover the emerging themes and one of the case study. But before that, we will just quickly look at the valuation and typically how do we analyze the valuation at RHPMS. So we'll try to put some light on those themes. So in this table, as we can see, we have captured different indices and their current P like Nifty 50, Nifty 500, Nifty Mid Cap, and also the small cap 250. So it's a fairly large range of indices covering top 500 companies by the market capitalization in India. And as we can see, so what we have done is we have tried to forecast the EPS growth for each indices or the profit growth for the each indices. So we are expecting around 11% growth in moderate case in Nifty 50, similar around 14% for Nifty 500 and 17% for mid cap and small cap space for the next 5-year perspective. So in 2 years, maybe in couple of years, there could be little bit boost in the EPS growth because of the lower base. But in general, we think like 16 to 17% compounding can also happen in small and mid cap space. Now, these are, if we look at the current P numbers, which are 22 for the Nifty and 33 for mid and small cap. So in absolute terms, they will look expensive, but we don't look at the number only from the absolute point of view. So we also adjust the P for the growth that they are commanding or the growth at they are generating in the underlying constituents. So before that, we will take one example to understand how we do the forward PG or the PG ratio calculation, which helps us to understand that is actually the index expensive or not. So let's take example. Let's say one person is living in the city A, whose house is worth around 1 crore, and the second person is living into the city B, whose house is worth around 2 crore. So if we look at the person B, second person which living in city B, whose house is expensive in absolute terms, but it does not mean like the city B is expensive. So to understand like whether actually the city B is expensive, we will look at the square feet or the size of the house rather than the absolute amount of house. And in this case, if the person second person which has home whose home is around 2 crore, if he's living in the 2000 square feet size home, so he's paying around 10,000 rupees per square feet, while in the first person who is living in the city A, who is living in the house of worth around 1 crore, and if he's having the size of house is only 500 square feet, so he's essentially paying 20,000 rupees per square feet. So although optically it will look cheap, 1 crore of house, but it is expensive if we compare on the like-to-like basis on the per square feet basis. So, so city B, which looks optically expensive, it's not optically expensive. On per square feet basis, we will come to understand city A is expensive versus the city B. So essentially that same principle or the same logic also applies to the valuation that we, when we look at in the absolute terms, it will always look 22 will be always less than the 33, and 33 will look always expensive, but we have to adjust it for the growth that they command. And what we have done in this table, basically we have forecasted the 1 year, 3 year, and 5 year PE numbers based on the EPS that we are expecting for the 1 year down the line, 3 year down the line, 5 year down the line for all indices. And we have adjusted it. So as you can see, the Nifty 50 example we take. So we are expecting around 11% growth over the next 5 years. And the PE numbers adjusted are around 20.1, 16.3, and 13.2. And if we look at the current PEG of the index, which is so it's coming around 2. So essentially, we are dividing 22.3 by the 11%, which is coming to. Similarly, Nifty 500, we are dividing 24.5 divided by 14%, which is 1.8. And similarly, mid and small cap is around 2x for the on the PEG side. But if we extend this PEG ratio on 1 year, 3 year, 5 year down the line. So if you look at the typically the Nifty, which looks cheap on the absolute terms, will start to look little bit relative expensive if we have investment horizon of around 3 year to 5 year period. So we can see it becomes 1.5 and eventually it becomes 1.2 5 year down the line. But the small and mid caps will cool down from 2 to zero point 0.9 or 0.9 for both of them. So the simple logic behind this is that like the earnings growth for both of the indices which underlying constituents are generating is very high or materially high versus the above indices like large cap indices. It is also because of that there are Nifty 50 comprises large cap companies which are literally like which are mainly in the maturity phase, or some of the companies are in the decline phase. But mid cap and small cap space has typically the high growth companies, which are early growth rate companies or the mid growth size companies. So they generate high growth rate and also they have long growth way or the high terminal value because of the long pathway available for the future growth. So we need to incorporate all those things and then only we can make sense of the valuation, what valuation is telling us. If we look at the isolated number in isolation or the absolute numbers, it will not give us the true picture. It will only lead to the distorted picture. So that is how we look at the valuation in our humble opinion. We think that like small and mid cap space relatively better of a relatively better chance of valuation re-rating if one is looking at 3 to 5 year perspective. It may remain challenging because of the liquidity constraints. Typically, large cap enjoys very high liquidity coming from the institution side. The liquidity tends to go down when we enter, let's say, mid cap, small cap, and even some of the names which are beyond 500, Nifty 500 names. So the liquidity will be typically lower in those names, but it comes with the reward of the higher multiple rating. So that is how the valuation stands at the current point of view. Now we will move on to the next slide. So basically, as we are moving towards the $10 trillion mark in terms of the economy, currently standing around 4.25, 4.5 trillion dollar. And so there are some key drivers that we think like this will propel the economy. So first is the government capex. So we believe like government is focused on building the infra, and in past they were spending more than 20% growth on capex side in the last 2 3 years, but now they have come down to 10 to 12% kind of sustainable growth rate, and we think that this will continue for the next 4 to 5 years as well. Second thing is a PLI. So government has announced a production linked incentive scheme for the 14 sectors with the outlay of 1.97 lakh crore, and it has already 1.76 lakh crore have been already utilized by the investment route, and it has also led to the 16 lakh crore of sales in cumulative basis, and also the 12.5 lakh direct and indirect jobs. The third driver is like the expansionary policies, like which are fiscal and monetary policies. Energy transition that we are aware of, like India is trying to reach 500 gigawatt the renewable energy mark. Fifth is China plus one, like global side, the countries are trying to diversify from the Chinese sourcing to, let's say, other countries, and we are also one of that beneficiary. Sixth point is maybe financialization of savings, and the seventh is rising per capita income. So these 2 points are combined, like as we are seeing the tax cut and tax benefit, and also the GST reforms that we have taken place, that will also lead to the higher disposable income and higher amount available for the saving at the hands of the retail people, or also the at a population level. So that will lead to the some of the money also coming into the finance side, which is a financial market. So that is how we think, like these are the seven key growth drivers which will act as a bedrock for the upcoming bull market. Now we'll move on to the themes. So basically, the growth drivers which we have highlighted. So we have selected around seven themes. Out of that, we will spending time on the discussing five themes, and also we'll discuss the latest development that has happened in the each themes after the GST reform. So first theme is the wealth management, coming wealth management space. So currently, like the reforms and the tax impact that we will see, so it will also lead to the higher disposable income at the hands of the investors, and people will like the need of wealth management will also arise. So if we look at the current share of financial wealth in India, it's around 25% versus the US 70%, and the global average is around 60%. And if you look at the professionally managed wealth portion, so India is around 15%, globally 65%, and US at 75%. So there is a huge gap in terms of the penetration of the wealth management companies, or the wealth management which is managed by professionals. So we see like this penetration to go up, inching up maybe 20-30%, eventually reaching to the 50-60% of the global average in a couple of decades. And the HNI population, basically, which is around 7.9 lakh people. So basically, we have considered $1 million net assets as a HNI definition. That will also double up in next 2 to 3 years, around reaching almost around 16.5 lakh. So like government has also recognized like this, there is a need to push the sustainable and long-term investment. And with that thing in mind, like SEBI recently came up with the boost for the distribution side. So they are also incentivizing the mutual fund distributors or the market intermediaries to accelerate the long-term investment. The sole reason behind this push was because the FNO loss, which was around 74,000 crore in FY24, has gone up again by 40% and reaching almost 1 lakh crore in the FY25. So a lot of money has been lost from the retail side, especially into the speculation side, or it kind of like a gambling kind of activity. So government wants to curb those kind of losses, and the distributors will get incentive of around 1% of the total committed amount in case of lump sum, and in case of SIP, the incentive will be around 1% of the total SIP inflow in the first year. And the incentives are capped at 2,000 rupees. Of course, the females will get incentive, female investors will get incentivized basically irrespective of location. And for the male investors, beyond 30, like beyond the top 30 cities, the distributor will get 1% incentive. So government is also keen to increase the long-term investment into the financial market, curbing the short-term speculation activity. And we think like the current wealth management space from the current juncture, which can go up around 3x in the next 5-year perspective. So that is how we see this wealth management, and the steps that government has taken will further propel this growth story in the foreseeable future. Now we'll move on to the next theme. So second theme is coming from the discretionary space, which is the fashion retail. So current GST reforms are also phenomenal when it comes to the consumer discretionary side. So if you look at the current apparel market size, somewhere it's around 5.5 lakh crore, and we expect it to reach around 10 lakh crore, 10.5 lakh odd crore by the 2027. And the current GST reform which happened, so earlier the ready-made garments till 1,000 rupees was charged around 5% GST, and above that the GST was around 12%. But now what government has done to support the middle class and the lower middle class, and the basically the low income groups, they have raised this limit to 2,500. So the clothes below 2,500 will be charged flat 5%, and above that will be charged 18%. So the fashion retail companies which are operating in the value fashion side, or the mid chain side will get like huge benefit of you. We can mention earlier they were getting around lower benefit. Now they will get differential benefit of 13%, like 18% versus the 5%. So they will see the accelerated expansion in the volumes, which will lead to the operating leverage and also lead to the exponential profit expansion in the underlying businesses. So that is how it will act as a tailwind, and we see like government reforms will act as a tailwind for this space as a whole. Now we'll move to the third theme. The third thing which we like is again from the discretionary space, which is jewelry industry. And if we look at the domestic jewelry market size, somewhere around $84 billion in FY24, and it is expected to reach around $150 billion, $145 billion by 2028, around 16% CAGR growth in terms of the industry expansion. And if you look at the current organized segment, which is around 37% is the organized part of this industry, which is around $25 billion, and it is expected to reach around 43%, leading to the $62 billion of the organized pie. So the organized pie will grow at a 20% CAGR versus a 16% growth rate. So there is already tailwind for this segment because of the shift from unorganized to organized, because of the larger and like larger portfolio which is available with the organized player in terms of design and the quality of the designs that they produce. But one interesting thing that we have recently like when we were interacting with the promoters of the company, so what we saw was like, because the gold price has almost close 1 lakh mark, almost reaching 1.1 lakh on the 10 gram side. So the shift is happening. So now people are like preferring 18 karat, 16 karat or 14 karat jewelries. And some of the companies have also launched the 9 karat jewelry in the fashion jewelry segment. So what happens, like as the caratage goes down, your making charges go up. So typically your 22 karat jewelries with the moderate design will attract 7 to 8% kind of making charges. But if we go down the carat and we increase the gemstones or the diamonds, so the making charges will go up eventually to double digit mark, maybe 12%, 13%, and it can also go up to 18% in some of the cases where the stud ratio is high. So these are the B2B charges, like the making charges where the B2B companies charge, but the B2C companies will again put their own premium. They will charge 25-30% like Tanishq and Kalyan and all. So typically the making charges are going up, even though the actual gold consumption can go down for in short term, but the margins will go up for these companies because the people are shifting towards the low carat jewelries basically. So this is again acting as a tailwind, and we think like from the next 4 to 5 year perspective, jewelries have all the growth levers in place, and organized will dominate the unorganized part going ahead. Yeah. So moving on to the next theme. So fourth theme, which we were very vocal even our past webinars, is the healthcare space. So as per the WHO mandate, we need at least 3 beds for 1,000 people or the 1,000 population. And if you look at the 145 crore population of India, so we need at least 43-44 lakh bed on the active bed side. But currently we have around 19 lakh beds, 12 lakh beds from the private sector side, 7 lakhs from the public sector side. So you have a huge deficit in terms of 24-25 lakh additional bed required over the future course of time. If we have to, let's say, meet the target of WHO by the 3x mark. And if we look at the global average, so we are way down. We are almost at 1.3 as of now, and the global averages are quite high. And also we have a huge potential to increase our beds per 1,000 people population. And with this thing in mind, like government has also brought down GST in some of the critical items which are used in medical space, like the imaging side, especially like MRI or the CT scans, which are the diagnostic machines or X-ray machines. Earlier they were charged around 12% or in some cases 18% GST. They are brought down to almost flat 5%. So government is also understanding and that we need to accelerate the investment in the healthcare space. We have to reach, because this is a bedrock for any strong economy or the economy which needs to become, let's say, developed economy. So we need to have very strong healthcare infra, and government is also cognizant of the fact. And with that thing in mind, they have drastically reduced the GST in some of the critical items which are um, required from the investment perspective. So we think like this reform will again act as a tailwind for the hospital space side, and we think like this thing can also compound the at overall level around 16 to 18% in terms of the sales growth at an industry level. So that is how we see the healthcare space from the next 4 to 5 year perspective. Now we'll move on to the last thing before we discuss the case study. Yeah. So the last thing is basically the renewable energy space. So currently, our India's vision is to have 500 gigawatt of capacity from the renewable space side. So currently, we are at around 220. We want to reach 500. So essentially, 280 gigawatt of capacity addition in next 5 years, 45 gigawatt for each year. And if we look at the solar, so solar will reach from 105 to 280 gigawatt. Similarly, wind will double and hydro will also go up 1.5 times. So that is the vision of the India or the Indian government at a large. And to further push this vision or make the companies to invest aggressively on this space, their government has cut down GST from 12% to 5%. So this will lead to the huge savings on the investment side. It will lead to around 1.5 lakh crore of savings at a cumulative level over next 5 years, and it will also reduce the cost of the project. So currently the unit economic works like 40 million of investment per megawatt capacity buildup. So that will lead to the savings of around 2 to 2.5 million, which is 20 to 25 lakh. So around 6 to 7% reduction we can see in the project cost. That will push the IRR of the companies which are operating this renewable energy plants or renewable energy space. So it will also lead to the 6 to 7% incremental push in terms of the profitability for these underlying businesses. So these are the themes which we think like which have will have like disproportionate tailwind from the GST reforms, and also the vision that Indian government has for the next 5 years from the at least from this tenure perspective. So these are the themes. Now we'll move on to the last section of this today's presentation, which will be the case study. Yeah. So before we discuss this case study, so just a quick disclaimer that the business that we are discussing is only for educational purpose, and please do your own analysis or maybe discuss with your financial advisor before making any investment decision. So today we will be discussing the V2 retail. So it is coming from the theme of fashion retail that we have discussed. So basically this V2 stands for value and variety. This this company operates in typically the eastern part of India. They are operating in the tier 2 and tier 3 cities. As of now, as of June end, they have around 216 stores across 165 cities, 21 states they are present. But around 70 to 80% stores are in the four states like Bihar, which has the highest store around 39, UP is around 38, Jharkhand is around Jharkhand, and again Odisha is around 28 stores. So these four states have higher stores so that is the main operating territory for this company. And when we met this management somewhere around last year in the quarter 4, somewhere around March, we started to interact. So when we're discussing with this promoter, like how they operate their business, so what we understood from a differentiation point was that for this particular business, so typically they don't follow the end of season trend, which typically the fashion industry follows. Like if we look at the companies like Pantaloons, or let's say Trent or Westside, which is Zudio, and other fashion players, they will run at least 2 end of season sales every year. But this particular company does not believe in that philosophy. What they do is they measure the daily churn of the inventory on the daily basis. And if some particular item or there's a particular category is not moving as per their expectation in the 15 days, first 15 days, so they will put it on the discount. So what they do is like they don't wait for 6 months to that slow moving category to be on their shelf. So they will replace it with the high churn or the high inventory turn items immediately. So that will lead to the lower leakage on the throughput side. So that will also push the throughput rate at a overall level. So if you look at the per square feet sales of this particular fashion retail space. So it's around 1,000, 1100 odd range on the per square feet side. And then metro stores are operating at 1,500 square feet. But when they open a new store, so they break even in the first month itself because of their this philosophy. They generate around 500 rupees square feet, which is their break even in the first month itself. And at the end of the first year, the new stores are generating around 800 to 900 per square feet kind of sales. So that is how they make their stores profitable from the inception. And we think that we thought like this is quite different from other people or other players that were following, and we conducted our due diligence, and we onboarded this company at a 15x EV by EBITDA on the trailing basis. So our entry price was around 450, 456 rupees, and our vision was like in the next 4 to 5 years, its earnings will go up around 3x and multiples will also expand. So it will generate decent return. But fortunately, with the industry tailwind in the last year, so the re-rating played out like very well, and we saw the 2.5x multiple re-rating EBITDA growing around 1.8x, and we got around 4.5x kind of return in this particular security. So, and going ahead, like they are currently adding around 100 and 120 stores this year. Going ahead, they have planned to again add 130 to 150 stores for FY27 with SSG of around 8 to 10%. So we think this story can still compound their EPS and the EBITDA growth more than 25-30%. But we need to keep one thing in mind. So when we are dealing with, because this particular company is coming from small and micro cap space. So last, if we look at the last calendar year, so in 8 or 9 months, it went up 4x. So 4.5x. So it does not mean like they did some exceptional thing in that only 7 or 8 months. They were doing exceptional things from the maybe last 3 to 5 years when they were like opening their stores. So currently they are at 216, but in 2020 they were below 100 mark. 2022, so they were trying. Every year they were doing 30 to 40% growth in terms of store network, and eventually street recognized that effort somewhere around 2024. So we can essentially say like maybe such kind of stories, when street catches such kind of stories, so they will discount the future profit very aggressively. But one needs to hold those stories for maybe 3 to 5 year perspective, then only we can get the benefit of unlocking. So in a recent time, because we have a lot of small cap and some of the mid cap companies, they are not having the liquidity because of the persistent selling going on from the FII side, and of course the mutual funds that SIP inflows that we discussed. So those typically focused on the Nifty 500 or the Nifty 750 companies. There are very large set of companies on the NSE side around 13-1400, which are beyond the 750 companies, which does not get benefit of this SIP infusion. But when the liquidity comes, these companies go up drastically. The re-rating happens very magnificent in a magnificent manner. But we have to be patient. When the liquidity is not there, even if the profit is growing up, the stock price will not move. So we have seen happening with the V2 even before we investing. So profit was still growing 50-60%, but stock price was not catching up. But when we entered, so subsequently the management started to interact with a lot of industry participants, and the story got unlocked. So similar is the case for the businesses which come from the small and micro cap space. One needs to have the investment horizon in mind before one plans to invest in such kind of stories. So that is all about the V2 retail side. And in conclusion, what we believe is like majority of the pain is behind us, and the government has taken very active steps in terms of the GST reforms and also the tax benefit which will accrue from the this year. So that will push us on a, let's say, that will kickstart the new cycle in terms of the wealth creation from the domestic market perspective. And we think that maybe short-term pain may be there for a couple of quarters, but then like as we have seen the previous market cycles as well, so SMID remains a better place when the upcycle kicks in. So one can look at from the investment perspective of maybe next 3 to 5 year perspective. Of course, the people who doesn't have high risk appetite, they should not they should stick with the large and mid space, or maybe the flexi cap or the large cap funds. But the person who has high risk appetite and understanding of the economy at a large should definitely prefer this kind of space from the investment perspective. So I think that will be all from our side for